Luke Stein here, and I'm going to go into a little bit more detail on the first of our key financial statements, which is the balance sheet. So the balance sheet provides information about the following main components of the firm's finances as of a specific date, generally the end of a fiscal period, like a fiscal quarter or a fiscal year. On the left-hand side of the balance sheet, all of the firm's assets are going to be listed. And assets refers here to the things that the firm owns, although, as I mentioned, and I'll highlight again, they're going to be recorded at cost. That is to say what the firm paid for them. And so assets that the firm didn't pay for may, in fact, not be listed at all on the firm's balance sheet. On the right-hand side of the firm's balance sheet, we're going to list the sources of financing that the firm has received. And that means the firm's liabilities and shareholders' equity. So liabilities refers to debt that the firm has, money that it has borrowed, either explicitly or otherwise, but that it owes to some kind of stakeholder. And then stockholders' equity refers to financing that's been received in exchange for an ownership stake in the firm. And the key balance equation, and why we call it a balance sheet, is that total assets equals total liabilities plus total shareholders' equity. So we generally draw a balance sheet with assets on the left-hand side, liabilities and shareholders' equity on the right-hand side, and those two pieces need to balance or add up. Of course, we can do just the smallest bit of algebraic rearrangement and subtract shareholders' equity from subtract liabilities from both sides, and that's going to give us that equity is equal to assets minus liabilities. And sometimes that form of the balance equation is going to be more useful for us. So let's talk about sources of financing. Financing is listed on the right-hand side of the balance sheet. So in the upper right-hand side of the balance sheet, we're going to list debt financing. So that's borrowing that the firm has done, which means that the firm has generated a liability. That means it owes somebody money for some reason. In the lower right-hand side of the balance sheet, we're going to list equity financing. So that's funds that have been put in by the firm's owners. So here's an example of what a balance sheet for a firm might look like. So this is a balance sheet for H.J. Boswell Incorporated. And in fact, if we kind of look in detail, we might notice that this balance sheet appears to be listing balances as of two different dates, December 31st, 2012 and December 31st, 2013. And indeed, this is in fact not one balance sheet, but two balance sheets. So in the left-hand columns of each side, we've got the balance sheet for fiscal year or calendar year 2012. So we've got assets, liabilities, and equity as of the end of calendar 2012. And then in this right-hand set of columns on the left-hand side and the right-hand side, we've got what is in fact another balance sheet for the end of 2013. And what's nice about having two balance sheets next to each other and lined up this way is that we can compare changes. So we can see, for example, that from 2012 or the end of 2012 to the end of 2013, the cash position that Boswell had went down by $4.5 million from $94.5 million to $90 million. And that's the kind of change that's going to be investigated and explained further by looking at other financial statements, in this case, by looking at the statement of cash flows. So a quick overview of sort of how the specific accounts on the balance sheet are organized. A real accounting class would go into more detail on exactly, what defines each of these possible categories. But roughly speaking, you could think about the left-hand side of the balance sheet as sort of listing assets in rough order of what we call liquidity. So things that are at the top are assets that can be used for almost any purpose at a known value and can be spent in a sense or liquidated very, very quickly. So cash means cash. You can basically buy anything you want, today or tomorrow with the cash that you have on hand. Boswell ends the year with $90 million of cash, or end 2013 with $90 million of cash. Then as we kind of move down from top to bottom, roughly speaking, you can be thinking about assets that can be used to buy things or to pay out shareholders or to pay back debts less and less confidently or quickly. So the next category that we have listed here is called accounts receivable. Accounts receivable means that the firm has already made a sale and they've already delivered a product, but they haven't yet collected from their customer. So this is a debt, but rather than a debt owed by the firm, which would be a liability, this is a debt owed to the firm, but it's a very particular kind of debt that's owed to the firm. It's a debt that's owed by customers to whom they've already made deliveries. So There's 2 steps involved in generating an accounts receivable. Step 1, you have to sell something. And step 2, you have to not yet have gotten paid for it. And generally speaking, if you deliver something to a customer, you expect that they're going to pay you relatively quickly. You might imagine offering them a week or a few weeks or a month or potentially even a few months to pay. You can't sort of use your AR or accounts receivable in order to buy stuff as quickly as you can cash. But you'd hope that you could liquidate this stuff relatively quickly. Okay, then we move down to inventory. So what's inventory? Inventory is stuff which is produced but not yet sold. So unlike AR, where you've sold it but you haven't collected, inventory, you haven't even sold it yet. So this is going to be a little bit sort of slower. There's a little bit more speculation. Is there actually going to be market demand for this product? What kind of price are you actually going to be able to charge for it? So this is, as of the end of 2013, Boswell's got $378 million in inventory, and inventories are recorded on the balance sheet at cost. So that $378 million doesn't mean that Boswell's necessarily going to be able to sell that stuff for $378 million. In fact, they would hope to sell it at considerably more than it costs them to produce those goods. Unfortunately, though, some of it could go bad. It could get spoiled. The products might not be appealing or interesting to the market anymore. So how much are they actually going to get when they sell this stuff? It could be more or it could be less than $378 million. As we work our way down, though, we're sort of less and less confident about the value of this stuff and the speed at which it could be used for other purposes. And then there might be some other what are called current assets. So if we imagine kind of drawing a line through the balance sheet here, everything above this is what we call a current asset. And a current asset is defined in the accounting rules as an asset that you reasonably expect to be able to use for other purposes within 12 months or 1 year. So cash you could spend tomorrow and you've already got it. AR you expect you could almost certainly collect from customers within the next 12 months. Inventory, if you've already produced it, you'd hope you're going to be able to sell it within the next year. And other current assets is other things that meet that kind of 1 year standard for the firm. Everything below this, that gives us a total current assets. So everything now below this line is non-current assets, sometimes called a long-term asset, and sometimes also called PP&E or property, plant, and equipment. So PP&E, property, plant, and equipment, or long-term assets are things the firm expects to have around and therefore not liquidate for more than a year. So gross plant and equipment is going to be the amount of property, plant, and equipment, long-term assets that the firm has purchased. But like most things on the balance sheet, it's going to be recorded at cost. So the firm paid $1.845 billion for all the stuff that they still have around as of the end of 2013. But of course, that stuff may not be worth as much as when they paid for it. They bought laptops. A laptop lasts a few years, but an old laptop's not worth as much as it was when you paid for it. If you have equipment, that equipment may slowly be getting worn down. It may be getting used up. So they paid $1.845 billion at some point in the past for all of the long-term assets that they still have on the books. But the adjustment that tries to capture the fact that those things may be worth less than they were and then they paid for them is called depreciation. And accounting rules dictate how much depreciation the firm can take of the stuff that they still have on the books at the end of 2013. They paid $1.8 billion, but the accounting adjustment says that that stuff might be worth very roughly $517 million less than they paid for it. Typically, these accounting determinations or depreciation determinations are made using rules of thumb about how long a particular type of capital good should last or how much it should decline in value over time. And that may or may not reflect the actual rate at which those things have declined. So if we subtract off that accumulated depreciation from that gross property, plant, and equipment, it means that the balance sheet gives sort of a very rough accounting-based estimate that property, plant, and equipment might be worth, and I put worth very much in quotes, $1.3 billion. But that accumulated depreciation amount may or may not actually reflect the change in value. And as I've now noted several times, and I'll harp on a number more, there may be other stuff that the firm never paid for that's not recorded here. So is the firm worth $1.97 billion? Probably not. There's not likely to be any brand equity. They may have very high quality employees with whom they have great relationships. They may have good business practices, all kinds of stuff. Anything that they didn't buy is not likely to actually be here on the balance sheet And therefore, this is an accounting-based measure of the dollars of assets they have. And we call that the book value of assets, but there's no reason to necessarily think that it's the same as the market value of all of the assets that the firm owns. Okay, let's move over to the right-hand side of the balance sheet, and let's look at liabilities, which are up here in the upper right-hand corner. Then we'll move to looking at the owner's equity stake. So in the same way that we moved down the asset side of the balance sheet from kind of short-term to longer-term, we're going to do something similar on the liability side. We're going to start with short-term, also known as current liabilities. And the firm's current liabilities means liabilities or debts that it expects to have to pay within the next 12 months. So that current asset and current liability split is typically based on a less than 12 months versus more than 12 months. And as we move down from AP to short-term notes, these things are sort of perhaps longer term, but also we move from things that are sort of directly related to production and sale of goods to things that may not be. So as of the end of 2013, Boswell had $189 million in accounts payable. What does accounts payable mean? Well, it means that you've incurred some cost of goods sold, you've incurred some expense in the course of producing something, but you haven't yet paid your suppliers. You haven't yet paid your suppliers for it. So these are debts that are owed to suppliers. There's a two-step process for generating an AP. Number one, you got to get something from a supplier. And step two, you have to have not yet paid them. Accrued expenses. So accrued expenses are a lot like accounts payable in the sense that they're kind of operating debt, but they're not necessarily money that you owe in the direct course of having produced something that you're going to sell. So this might include things like wages that are owed to employees on their paychecks, not production employees necessarily, but other employees that haven't yet been paid. This could include things like taxes that you owe the government, but you haven't yet had to pay. So both of these are going to likely be what we might call operating liabilities. They're money that you owe because of the way that you've run your business. And in contrast, short-term notes is going to be money that you've borrowed in the financial markets that you expect to pay within the next year. So if you've borrowed and you owe money typically through some kind of short-term debt security, which we might call a note or a note payable, commercial paper would be one name for a security like this. They expect, in Boswell's case, to have to pay $54 million to financial markets within the next year. So again, this is paid to suppliers, paid to other folks in the course of production, and this is paid to some kind of financial lender. And that gives us the firm's total current liabilities they expect to retire within the next 12 months. And then in contrast, their long-term debt is the debt that they expect to pay in more than 12 months. And generally speaking, only a financial institution will lend you money for more than 12 months. So usually all of the firm's operating debt or liabilities are going to be short-term or current, and all of their long-term debt is going to be a more financial liability. So that gives us total liabilities. Current liabilities plus long-term debt is going to be total liabilities. And we see that as of the end of 2013, Boswell owes $1.06 billion. Okay, then we move finally to the lower right-hand side of the balance sheet, and that's going to give us a statement of shareholders' equity. So this is money invested by the firm's owners. For our purposes, we can actually think about par value and paid-in capital and just kind of add them up. There's sort of a reason that they get broken out on some balance sheets. But what this 324 plus 45 million tells us is that shareholders have actually paid $369 million into Boswell and received shares in exchange. So there was share issuance, and an ownership stake was given to owners. And in exchange, they put this amount of actual cash or similar into the firm. In contrast, retained earnings are money that the shareholders never actually saw in their pockets. They're profits that were earned by the firm. And because the owners own the firm, profits owned by the firm belong to the owners. But rather than take those profits out in the form of dividends, the shareholders agreed to let those funds stay within the firm, We call that reinvestment, and all the money cumulatively that's been reinvested in the firm is called retained earnings. So we can actually see that as of the end of 2012, Boswell had $382 million of retained earnings. Then as of the end of 2013, they had $542 million in retained earnings. And so that change is the amount that must have been reinvested in the firm over the year 2013. In contrast, there's no change in par value and additional paid-in capital. So in 2013, Boswell didn't sell any new shares to shareholders. They didn't issue any new shares. They didn't buy any shares back. The amount of actual cash flow to and from shareholders in terms of financing the firm, it looks like there was none, but the firm must have been profitable in 2013, and some of that profits got reinvested in order to increase retained earnings. Okay, so that's kind of basic outline of what's on the balance sheet. Let's talk about the balance equation. So the balance equation tells us that assets equals liabilities plus equity. So one way to think about this is anything the firm wants to buy, okay, these are uses of funds. Anything the firm wants to buy, it's got to get the money to buy that stuff from somewhere. And where can it get it? Well, it's got to get it from one of two sources. Either they can borrow it, okay, and that's liabilities, or they can sell a stake to the firm's owners. So the left-hand side of the slide shows what's kind of the classic statement of the balance equation, assets equals liabilities plus equity. Really, it's telling us that uses of funds equals sources of funds, and the two ways that the firm can finance itself is through some mix of liability plus equity. The way I sometimes like to think about this statement is this is kind of like the manager's view. Okay, so the manager of the firm might say, we really want to buy some inventory, we want to buy some property, plant, and equipment, we need some cash on hand. They might estimate all the assets that the firm is going to need, and then they've got to figure out where to get the money to buy all of that stuff. The right-hand side statement, it's obviously just the simplest possible algebraic rearrangement. I sometimes like to think of this, though, as the owner's perspective. And I apologize for my bad handwriting on the slides. The owner's perspective, owners of the firm have equity. So one way to think about an owner's perspective on the firm is that equity in the firm, that's what they've got. That's theirs. They own the firm, and the firm owns all this stuff called assets. So those assets are owned by the firm's shareholders. The equity holders own the firm owns the assets. Unfortunately, before the equity holders can kind of do anything good with those assets, they also have to pay off all of the firm's debts. So if you think about, for example, owning a car, you might have a car that you drive home from the dealership lot, and that car is yours. You're the equity holder in that car, and that car might be a $20,000 asset if it's a $20,000 car. Unfortunately, you have to pay the bank all the money that you borrowed, and maybe you borrowed $15,000 from the bank. You took out a $15,000 car loan. So what's your equity in the car? Well, it's the $20K of car minus the $15K that you own the bank, and that means that your equity in the car is the $5,000 in between. So as I've now highlighted several times, those assets are not generally recorded on the balance sheet at value, they're recorded at cost. So that means that this equity estimate that we get using E equals A minus L, it's only a book value of equity. It's not a market value of equity. And there's no indication that you could actually sell this car for $5,000. You come to me, you say, hey, Luke, I got this cool car. I paid $20,000 for it at the dealership, and I've got a $15,000 car loan. How much will you give me for it? I might say, man, that's a sweet ride. I'll give you $3,000. You can't be like, well, no, I've got $5,000 of equity. No, the book value of that asset may be $20K, but the market value is somewhat less. Okay, so how sort of do we think about the decision as a manager to raise funds from debt versus equity? Debt and equity provide different claims on the firm. Okay, in particular, if you lend money to a firm, you don't own that firm at all. It's not your firm. And you may have some supervision opportunity. You may have some ability to exercise control over the firm, but typically not much. And with most debt contracts, You know how much you're going to get paid back. You know when you're going to get paid back. That is to say, the interest payments, or in the case of a bond, we sometimes call those coupon payments, are fixed in advance. The timing of the principal repayment, in the case of a bond, we typically call that the face value. We know when this thing is done. You take out a car loan, you have a particular payment schedule that you've got to make back. So as a debt investor or as a lender, you're not likely to make more than you expect. You're going to earn a return that you know in advance. You might do worse because the firm might default. They may not have enough to pay you back. So the upside's typically going to be limited. The downside may be, you're not going to lose more than you put in. And the risk of downside is somewhat limited because you are likely to get paid first. So the firm owes you that liability. They need to try to pay you back before they can distribute profits to their shareholders. In contrast, if you buy stock, shareholders own the firm. So that means that they have the opportunity to exert some measure of control over how the firm is operated. It also means that their claim on the firm's cash flows is only what we call a residual claim. They only get what's left over after the debts have been paid. So the payments are not guaranteed. They might be zero. The firm might not even have enough to pay its debt holders, but it's certainly not going to pay its equity holders until after the debt holders have been paid their promised payments. The payments to debt holders are typically called dividends, but those dividends can only be paid out of profits. That is to say, money that the firm has left after it's paid all of its expenses, which means it has to pay its workers, it has to pay its suppliers, it has to pay taxes, it has to pay any debt obligations that it has. If all those obligations have been satisfied, then the firm has net income that it could potentially pay out to shareholders. And in fact, they may not pay dividends to shareholders. The firm's management may choose to reinvest some or all of that net income in the firm in order to try to grow the firm for the future. So depending what kind of control rights the shareholders have, depending what the corporate governance structure is, the shareholders may be able to claim the profits as dividends right away, or they might be willing to or be forced to reinvest some of those in the future growth of the firm. So stocks typically are going to have a much greater upside potential, but also a big downside potential because lots of other folks get paid first, plus managerial discretion may be involved in whether or not you get paid. So debt holders have fixed payments. Equity holders have non-guaranteed payments. Debt holders know when they're going to get paid. Most debt contracts have a fixed maturity schedule. Equity's forever. You might get paid soon. You might get paid later. That could be good or bad because you might get paid for a really, really long time. Not for a really long time, but you might get paid this year and next year and the year after and the year after. There's firms that have been paying dividends for 100 years. Debt is typically senior. That means that if the firm has money, it's got to pay the debt holders before it pays the equity holders. And if the firm goes bankrupt, in bankruptcy, assets are going to get distributed to the lenders before the equity holders get anything. And there's other differences as well that may come up. Equity holders tend to have more control. The firm is typically able to take a tax deduction for interest payments on loans, but not for debt payments. There's regulatory differences as well that come up. I've said this a number of times. I'm going to say it just this one last time. Book values on the balance sheet are super interesting and important, but they're largely based on historical cost. So that means that even if there's an adjustment to historical cost due to depreciation, that adjustment may be a high quality one, but it may not be a high quality adjustment. Any assets that weren't purchased are not typically going to be put on there. And because the assets may not be recorded at anything close to market value, the equity, which is equal to assets minus liabilities, is also going to be calculated using that book value and may not at all reflect the market value of the firm. One last calculation in slightly more detail about the numbers on the balance sheet, and that's a calculation called net working capital. So we already described the fact that assets and liabilities on the balance sheet are going to be listed, broken down by whether the firm expects to use or collect them within the next 12 months or not. So current assets are going to be assets that the firm expects to use within the next 12 months. That's typically cash, AR, inventory, and maybe some other stuff. And then current liabilities are liabilities the firm expects to pay within the next 12 months. And that's typically AP, short-term debt or notes payable, and maybe some other current liabilities. So the balance sheet has to balance, meaning current assets plus long-term assets has to equal total liabilities plus total equity. And parts of those liabilities are going to be the current liabilities paid in the next 12 months. So if we think about current assets as being what the firm owns that they're going to use in the next 12 months, and we think about current liabilities being what the firm owes that they expect to pay within the next 12 months, as distinct from long-term liabilities paid in more than 12 and shareholders' equity. Shareholders are invested in the firm for the long term. The difference between current assets and current liabilities is a number called net working capital, okay? And that's in fact the definition of net working capital is it's the difference between current assets and current liabilities, okay? So net working capital equals current assets minus current liabilities. So the firm illustrated in this diagram has positive net working capital. Their current assets are more than their current liabilities. That means that part of their current assets, part of their short-term assets have been financed through long-term sources of financing, long-term liabilities and stockholders' equity. On the one hand, that may provide a cushion for the firm because it means that they have more short-term stuff than they need to cover their short-term debt. On the other hand, it means that they had to have gone to the financial markets and either borrowed long-term or sold long-term stock or reinvested in order to finance even the current operations of the firm through current assets. So net working capital is a number we're often going to look at. It's one of the first analyses we're likely to do with any balance sheet for any firm, and sometimes we'll sort of revise that to try to analyze what we call operating net working capital by excluding any of the current assets that are financial, that are purely financial and therefore kind of non-operating current assets, and also any current liabilities that are more financing liabilities. So that's kind of a whirlwind tour of the balance sheet. There's lots more to know, and accountants are, spend a lot of time thinking about a lot of this stuff, but just a few of the key concepts that you need to have in mind as you look at a firm's balance sheet or as you think about forecasting your own firm.